It is so easy to get confused with all of the different strategies there are on YouTube, and I know that because I've been there, and the truth is that they are so overcomplicated and most of them just doesn't even work. So today I'm going to show you the strategy and I'm going to show you how to execute it in the real market, so make sure to stick till the end. So what I'm going to show you is the liquidity strategy with a very special entry model that you're going to see later in the video. And the goal of this video is going to be for us and for you to understand liquidity and to drastically increase your win rate in the first 90 minutes of the trading day, which is just going to be the first 90 minutes of the trading session. You can choose it whether you want to trade New York, London, or Asia. It doesn't really matter, but as long as it's the first 90 minutes, because that is when the most volatility is in the markets. So the first lesson we are going to have is about liquidity. So we are going to learn exactly what is liquidity and exactly how to find it on the chart. The second thing in this video is going to be the entry part, and we are just gonna learn about how does it actually work and why is it so good and why I love it so much and why does it actually work so well in the markets. So before we actually start, I just want to show you some kind of proof. So these are my profits, a monthly profit with using this model that I'm going to show you today. So just that you know that I'm not yapping about some strategy that I don't even use or that hasn't made me profit. So it's making me consistent profits month by month, and that is exactly why I'm teaching you this right now. Also, one very important thing is that it works on forex, options, crypto and futures, and you can see that futures right here is kind of colored. So why is that? Because I actually do trade futures and I think futures works the best with this strategy. So let's get into it. So the first big question of this video, what is liquidity? So first we need to know that 99% of people are going to lose money in the market. And why is that important? Because 99% of people are going to lose money, but the point is that those 99% of people are liquidity. So trading institutions, banks, you know, those big boys that are trading with billions of dollars, they are going to manipulate them in the market. So they are going to take 99% of retail traders, basically me and you, and they're going to manipulate them and basically just take their money. And that is the biggest reason why there is so many unprofitable traders compared to profitable traders, because institutions, banks, they are just made to kind of extract money from the markets, to just extract everybody's money, and that is exactly why 99% of people are going to lose it, because they don't understand the reason why they are losing. But today I'm going to show you how the liquidity is the reason that most, and I think 99% of people are actually losing money. And how do they actually manipulate people and extract their money from the market? It's by hunting their stop losses. So you know that how everybody in all of the videos on YouTube teaches you to put your stop loss on the obvious low, on the obvious high. Well, obvious highs and lows are going to be liquidity, and big institutions, banks, you know, big boys, they know that obvious highs and lows are going to be full of stop losses. So what are they going to do? They're going to drive the market to sweep those stop losses, to sweep those lows, those highs, and then the real moves are going to happen in the market. So we are always going to wait for the market to actually hunt those stop losses, and then we are going to look for some kind of entry. So I'm going to show you that. So right now, when we know actually what the liquidity is, now we need to learn how to spot it on the actual chart. So let's actually get to this example right here. So this is really simple. So you probably seen this, like other people saying how market is created of higher highs in the market, higher lows, higher highs, and that is how we map out structure, but that is completely wrong. So we are not gonna look at structure with some kind of higher highs and higher lows, because they are going to get manipulated. So as we talked about right now, people are going to get stopped out. 99% of people are going to get stopped out. Why? Because when institutions and banks enter the market, let's say right now is the market open, what is going to happen? So the first thing, if you are going to the upside and if the market wants to continue going to the upside, what is the market going to do? Market is going to hunt the stop losses. It wants to actually collect all of the stop losses. So they are going to drive the market towards the downside. And why are they going to sweep this low? Because a lot of people bought the market right here. Where did they put their stop losses? At this low. Also, a lot of people bought the market, let's say right here, right here, right here. Where are they going to put their stop losses? On this low right here. So at these two lows, there is going to be stop losses. It's very actually simple. And what the market is going to do, market is going to sweep, let's say, these first stop losses right here. And then what is going to happen, I'm going to show you why my entry later on is so good, because right now if we do get the entry right here by my model, market is actually going to go to the upside, but we can be certain of that without an entry. So we cannot just enter when the sweep happens, because why would market not go for another liquidity and then after that just go to the upside? So the point is, after we get a liquidity sweep, any liquidity sweep, it doesn't matter if there's two more highs down here and down here, we are always just going to wait if my entry model, which I'm going to show you how it's executed, and it's so simple and so logical once you think of it. So we are just going to wait for the entry model right here, and if it does not happen, we are just going to wait, maybe get another liquidity sweep and then wait for it again. If it happens, we enter the market and we just profit on it and target the next liquidity, which is either going to be this, or we can maybe get a movement like this in the market where we can just enter, let's say right here, and then target, for example, this first liquidity right here. So we are always going to target liquidity and we are always going to trade off of liquidity. Why? Because that is what banks, institutions, trading floors, you know, all of them do. So we are just going to follow that, and that is exactly how we are going to be profitable. So now on to the real question, how does the entry work? So first of all, we need to learn about one very simple concept, and that concept is fair value gap or imbalance. You can call it however you want, but what imbalance actually is, we need in total of 3 candles. You can see one right here, one right here, and one right here. It's very simple. All we need to do is look for the first candle's low and third candle's high. We just want to see an imbalance right here or a hole, and the same if it was to the upside. We just want to see, let's say, first candle's high and then third candle's low right here, and this right here would be imbalance. So it's really actually simple. So you just need to practice this on the chart a little bit and you will figure it out so easily. So once we know how to mark out these fair value gaps or imbalances that are created almost always in the market, you're gonna see a bunch of them. All we need to do is to make it an entry model. What we need to see in the market is of course a liquidity sweep. So as I told you, after we get some kind of liquidity sweep like this, then we are going to start searching for the entry. We want to see a last fair value gap in the market like this one, so last one before the sweep. So here is a sweep and this one is the closest. Maybe if there was another one right here, it wouldn't matter because this one is the last one. So after we get the liquidity sweep like this in the market, all we want to see, and that's literally all we want to see, is a closure above this fair value gap. Now why is this so logical? Because if the market just swept liquidity, so the market just swept all of the stop losses, and what the market did, market reacted off of it to the upside, as you can see with this candle right here, and basically what the market did is market closed above this fair value gap. So this body right here, so this part right here is the body of the candle, and what we want to see with that body of the candle, we want to see it close above the actual fair value gap. Because if it does not close like this, but it closed, let's say right here, leaving a wick to the upside like this, then that means that this fair value gap is actually still respecting and can easily push the market towards the downside. So all we need to see is after a sweep of liquidity, we want to see a disrespect of the fair value gap, because that is telling us that market does not want to continue to the downside, because the market actually disrespected something that should push the market to the downside. So it actually wants to reverse, and that is exactly when we enter. We enter on the closure, we put our stop loss below the body, below the wick, and then we just target the upside liquidity. Let's say this liquidity right here, we just target it, and that's how we profit. So it's so simple. And also I just want to show you the win rate that my model actually gives me. So you can see 30 wins and 6 losses. So they're just crazy for this simple of a strategy. So right now what I'm gonna do is I'm gonna actually go to the live market and I'm gonna show you exactly how I spot the setups, how I execute them, so you can do the same. Okay, so here we are at the actual live chart. So you can see right now it is 9:25 in the market and market open is just about to happen. So before we actually start, I just want to tell you some things about the time frames. So we are just going to use simple 4 time frames, and it's not even hard to look at them. So the point is we are going to use 5-minute time frame, 3 minutes, 2 minutes, and 1 minute. So we are mostly going to use one, but we just have to check out all the others for what they are doing. So what we are always going to do, but always, is start on the 5-minute time frame, and we are going to map out the liquidity. So the first thing is we move the chart to the left, and we can see right here how the market structure worked. We can see that it went to the downside, to the upside, downside, and you can see some structure. And what do we do with this? We just mark out lows and highs. So you can see we have a high up here, and then we have low down here, and then we also have this low that is just about equal as the one before, and that's literally it. After that, we are ready for the market session. We can also mark out some of these. So as long as it's some kind of low, it doesn't need to be crazy obvious like this one. It can even be, let's say, this low down here. As long as it's a valid low with some kind of a little pullback and then a continuation, that is good enough for us. So what do? On the 5-minute time frame, we just let the market play out. Okay, so let's see what the market is gonna do. So the market just opened, and you can see the market actually just dumped to the downside. So it almost swept the upside right here, and then after that it just dumped to the downside. So right now we are going to still stay on the 5-minute time frame. So you can see right here that the 5-minute left us a fair value gap. So if it left us a fair value gap, we don't need to go to the lower time frames. But if there was no fair value gap, if the market has just done something like this and left us with no fair value gap, we would just go to the 3-minute time frame, look for the fair value gap. If there is no fair value gap, to the 2-minute time frame. If there is no fair value gap, to the 1-minute time frame. So we just go from the highest to the lowest time frame to look for the fair value gap. So it's very easy, trust me. So once we are on the 5-minute and we do have a fair value gap right here, we just wait for the market to inverse it, and it looks like we just wicked above it and then came back below. So let's see if the market is maybe gonna inverse it right now, and there it is. So market just beautifully inversed it, and what we do is we put our stop loss below the candle's low, and then we just target liquidity to the upside. So the cool thing about this setup is I actually took this setup in the live time, because this was just few days ago. And what do? We just target the upside, and let's see how is it gonna play out. So you can see just market shot to the sky, and I have actually taken this setup on my live account. Okay, so let's go to the next example, which is gonna have something more interesting in it. Okay, so this is the second example, and right now in this example we are gonna see what the time frames are, if it's still gonna be 5-minute time frame. But first of all, we are on the 5-minute time frame at the market opens. So 9:25, market is just about to open. What we do is we mark out the liquidity. So if we map out how the market was moving, it was going like this, then it moved to the upside, a little retrace, started moving to the upside again, little retrace right here, and started moving to the upside. So for this time, it's not such a clear market structure that we had like this, but it's quite more small. I don't know how to call it, but you can see still we have lows. So this one right here, we have this one right here, and then we have this one right here, and also this one right here. So not the biggest lows, but it's still a low in the market, and it's going to be filled with stop losses. So as long as we sweep any of these lows and then get a setup or an entry model towards the upside, it's going to be good enough for us to actually execute in the market. So let's see what happens when the market opens. You can see that market just spiked to the downside. So right now we do not have any fair value gap. So what do? We just scale to the smaller time frame. So on the 3-minute we have a fair value gap, but it's really far away up here. And imagine entering this trade like this with stop loss like this, targeting this liquidity, that would just be abnormal. So let's see for the next fair value gap on a different time frame. 2-minute has the same fair value gap. Let's see the 1-minute. 1-minute does not have any fair value gap. So what do at this example? We just fast forward the market, we just wait and let's see what the market has to offer us. So we made a little spike to the upside, and here it is. Here is the fair value gap. So that is exactly why there is no need to rush it, because we just need to wait for the fair value gap. We also just try to go to the upside and then swipe this low once again. So we mark out the fair value gap on the 1-minute time frame, and then let's see what the market actually does. It wicks inside it, and then it closes above it. So what do? We just enter the market like this, stop loss below the fair value gap. So this time I'm not going to put it below the body, because the body is still inside of the fair value gap that we inversed, but I'm going to put it exactly at the low of this fair value gap right here. We are going to target the high up here, and it's not the biggest risk to reward, but it's still pretty decent, because it doesn't need to be 5-10 risk to reward for us to be insanely profitable. When there is 83% win rate, that is just going to keep us profitable even if you take 0.5 risk to reward. So let's see how this trade actually played out to the upside. So it looks like it came up slowly, and then it hit the TP perfectly. And then you can also see if you wanted to target something bigger, maybe to the left, some kind of liquidity, you could, but this is just enough for us because we just want to be in and out of the market. And that is basically it. I hope you liked the video. If you did, make sure to leave a like and also subscribe to the channel so you never miss any of these videos. Also, before you leave the video, if you want, you can go down there, you can claim a complete 10-page playbook of this whole strategy, so it's completely free. All you need to claim it and you have a complete PDF of this strategy. And then the second thing is, if you actually want to see my live executions and how I actually live trade, make sure to go down there. I'm gonna leave the link for the second channel where I upload all the trade recaps, live recordings, everything. And also make sure to check out down there if there is maybe still some ongoing spots for my private one-on-one mentorship. So maybe if you are lucky, you get to get in. And yep, with all of that being said, I'm just gonna see you in the next video. Peace.